Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Good morning, Will. Happy Royal Blue Tuesday to you.
For those of you who don't know, the I-70 series, that's the Cardinals versus the Kansas City Royals, is currently in play. The Royals took game one pretty convincingly. I think the Royals no-hit the Cardinals until the seventh. I believe Arenado hit a single there. So yeah, it's going to be an interesting series the rest of the way. I'm sure the Cardinals come back, get the series win, because we're not a poverty franchise, even though we've been acting like it this season. So
Ouch, that hurts. Well, I do have to say both teams haven't had a great season, and so
yeah.
this is our World Series for the Cardinals and Royals, I think, this year. Now, granted, the Cardinals have looked good here the last month. It's not All-Star break yet, so there's still time to turn around. But yeah, I'm taking
Well,
the wins where I can get them today.
yeah, it's watching both teams. You hope there's a lot of promise there, a lot of youth on both rosters. I know the Royals have a lot of really, really neat pieces when you look at like Bobby Witt and even MJ Melendez, even though he hasn't been hitting that well this season. But I don't want to get too far down the rabbit hole within the baseball talk. Ben, as we look toward the markets coming off of the holiday week, we saw some soft to moderate adjustments, kind of both positive and negative coming into this week. So before we dive into things, I'll give a quick rundown here. For July corn, we saw up 32 cents on the week. December 23 corn up 19 cents. December corn is at 5.28. July soybeans was down 20 cents at 13.21. November 23 soybeans down 26 cents at 11.71. Soybean oil for July was down just a little bit over a cent at 47.65. Soybean meal for July down $14.20 at $398 a short ton. July wheat down 5 cents at $6.01. And then July wheat for 2024 up a cent at 6.62. And then that July crude oil was down $1.37 a barrel at 70.68. So Ben, is there anything of note just starting off the bat as we come into this shortened week from a trade standpoint?
Well, I think for me, and maybe it's just recency bias there, but your last point or about West Texas Intermediate crude, basically at $70 a barrel. It's possible we could next week be talking about below $70 per barrel oil, just slightly probably. But to me, that is a better market than I anticipated, and better being relative. I guess if you're an oil producer, you're not as excited, but at least from a producer standpoint, we certainly had anticipated higher oil prices once we started hearing about production cuts of oil from OPEC, and then the continued challenges with Russia crude oil around the globe. So that West Texas Intermediate falling down to $70 a barrel, I think, is a big thing that I would not have anticipated 4 months ago.
Well, and just sticking with the general fuel discussion, we saw U.S. gasoline demand tick up the last couple of weeks. We're entering that summer driving season, like we've talked about. So, what does this mean? What do those two things, I guess, in correlation mean as we move forward?
Well, you're right. So U.S. gasoline demand was up 6% week over week. That pulled energy stocks down across the board, and that'll probably signal a little bit higher prices as we're dealing with lower stocks and higher demand here as we move through the summer. However, we're a dollar plus on average gasoline prices across the country, lower than we were this time last year. So even though I'm saying maybe a little bit higher prices relative to where we've been the last couple of weeks, over the next couple of months, we're still a lot lower than where we were last year, and that should signal some more gasoline demand and some more ethanol demand along with it. U.S. ethanol demand remains about 40 million bushels below the seasonal pace to where we need it. So I'm still on that train that I think USDA will eventually have to cut that target for ethanol to kind of get back down to where we've been trading. But we've got several months left to go, three months left to go in this marketing year, and so it is still possible, but got a little work to do to catch up.
Well, just talking about how USDA maybe sets those projections, obviously you don't want to, be too wishy-washy, flipping projections too quickly. But do you think there's a reason, like valid reasons that USDA might be holding out before adjusting downward?
Yeah, sure. So, and I should be clear, we all beat up on USDA. Every market commentator beats up on USDA in terms of where we think they're right, where we think they're wrong. USDA does a pretty darn good job for the most part, and it's often you hear it big when people disagree. Largely, and people get really mad and riled up. You hear almost nothing when USDA pegs it
Hits it
on
on the
the
head.
nose, right?
Yeah.
And they peg it on the nose like 98% of the time. And they have to make some reductions in those other areas. And so, it's fun, it's dramatic to sit here and pick them apart, but they do a pretty darn good job. The reason I say all that is USDA has a pretty straightforward and they're very transparent in their methodology and how they do some of this stuff. And at least for the World Ag Outlook Board, they have to have evidence to justify moving that number lower. And, they're probably looking at this summer driving season saying, hey, we've got a little bit higher use potentially of E15. We've talked about that, how I think it's about 5 to 6 million bushels extra corn, where we possibly could have a very strong driving season due to substantially lower gasoline prices across the country. And so they're probably sitting there saying it's not impossible to make this up. And it's they haven't seen the convincing evidence that we're not going to be able to make that up, and therefore they haven't moved it yet. So that's me sitting here saying USDA does a pretty darn good job. We can sit here and pick it around. My bias is that they will have to move it down lower, and that'll increase ending stocks, but there's still a chance that we can make this up.
Yeah, well, and just on that, looking at the how far below the pace might be, for the 40 million bushels, how significant is that?
Well, we're talking about 40 million bushels out of a 15 billion bushel crop on average, right? So, I mean, it's very small, but it does increase that carryout, right? We're already printing a 2 billion bushel carryout for next year. That was one of the largest year-over-year increases in the carryout we've ever seen. This crop isn't out of the ground. Shoot, it's not all planted in some parts across the country yet. And so we've got a long ways to go in this crop before we even start talking about production and then, ending stocks as well. But that 40 million bushels would be an increase in the carryout from this year to next year, potentially weighing on prices even further and just creating that mindset of, very soft exports, very large crop in South America, now potentially, even some revisions on the ethanol front. And that just kind of builds into that bearish mentality. So, it's small, but I don't want to sit here and say that it can't have big impacts in market movements because it just kind of feeds into that bearish sentiment as we look ahead.
Well, and obviously, there's two sides to this every time we talk about it. But, you look at maybe livestock producers moving forward. If you get that larger carry out, maybe that sets a little bit of security into the market for them as we see shocks. Maybe won't swing the market as abruptly, if tightness isn't as bad as it could be. Ben, looking at U.S. exports, still, not stellar, still declining a little bit, but mostly within expectations. Do you have any expectations moving forward for what our export sales will look like as we continue throughout May and into June?
Sure, and it kind of fits into what I was just talking about. So, corn export sales were negative for the second straight week in a row, and this was the third out of 4 weeks, or so the 4 previous weeks, 3 of those were negative export sales. That's unheard of from the United States. You have to go back decades before you start seeing negative export sales in April and May for corn, but they're becoming pretty frequent. And I think this is a trend that's going to continue for us moving forward throughout, the next. Moving forward, I'm not just talking about the next couple of weeks or months. I'm talking about years, because Brazil is becoming, and we've talked about this, everybody knows this, Brazil is becoming a major producer of corn, and they're becoming a major exporter of corn. And that changes our seasonality in terms of to export products. So, it was a pretty bearish week on the export front and declining export sales. We saw it in the wheat complex. We saw it in the corn complex. And unfortunately, I just think we're going to continue to see it in the corn for another couple of weeks. And this is a trend that we'll just have to, again, it's a change in mentality in terms of marketing decisions that I think we're talking about here on the export front.
Well, talking about marketing decisions and maybe, I guess, cash flow attached to that, Ben, last several days you came out with an article talking about the cash flows that farmers might be expecting over the next year or so, looking out, and maybe not the most positive expectation or a decent propensity for some negative cash flows. So what's your I guess thoughts on the situation? What might farmers be experiencing as we look out for the next year plus?
Yeah. And as you know, and as many people know, farmer questions or producer questions largely drive my extension program. Like most of what I do is because somebody has showed interest or I think it's of interest to producers. And so I've been getting a lot of calls of producers asking about the return on investment for different fertilizer management practices, different, pesticides and herbicides, stuff like that. And so I put together an article looking at the probability based on my cash budgets I put together for the state of Missouri. So we'll talk through some of these numbers if we have time. But I put together this assessment looking at given futures and options positions as of today, right? So the futures positions for new crop corn, and then putting a distribution around that fancy economic term to basically just say it's a sensitivity analysis of using options, how much does the market think prices can go up or down, to kind of put a distribution around this and see, okay, what is the chance that we have negative operating income at the end of the year? And over the last month, the probability of revenue not covering expenses for Missouri corn and soybean producers has grown as costs remain elevated and as commodity prices have adjusted downward to a large U.S. crop and competition from South America. So that's kind of the general theme is we are now at the point where there's actually a greater probability or a higher chance of not covering cost in Missouri now than covering cost, and that was not the case a month ago. So as these prices have moved down, we've seen kind of a change in terms of the outlook on product or in terms of profitability. I will make one note, if I can make a note here. I'll use my corn budget. I have non-land cost for Missouri corn production at $707 per acre. Now, most producers are going to look at that and say, now, Ben, that's way more than it costs me to put in an acre of corn. And I would generally agree and disagree with them. Do I believe that they can do it for less than $700 per acre in Missouri? Yes. However, like that's most of the time, that's not them taking into account the opportunity cost of using that land for something else or using that equipment for something else or taking into account interest expense to finance, their inputs for the season rather than using that money for something else. So all set aside, $707 is basically what an average Missouri corn producer for 166 bushels per acre of corn is what it would cost. And that's what I'm using, right? So I recognize that people do it cheaper. A lot of people have, own land and they're not paying a mortgage or they're not paying a cash rent. But yeah, that's where we're at. We're at a 60% chance of not covering costs, or 65% chance of not covering costs if you take into account a basis price.
So Ben, obviously this is heavily centered around Missouri, but I think a lot of this is still useful for farmers in other states as you look at the general economic factors that are causing this, the general U.S. production that you talked about, the competition in South America. So, what can farmers in, looking at Illinois, Indiana, Ohio, Iowa, it really wherever, how can they extrapolate really this discussion into their own states and their own operations?
Yeah, I think I can summarize this pretty simply, and it largely follows my my rally cry, my mantra, if you will, of these crops are not getting cheaper to put in. They're getting more expensive. And that's going to be a continual trend as we look forward next year, next 5 years, next decade. They're getting more expensive. And therefore, we have more risk to protect as producers. That is not changing. What I'm going to say is a solid risk management plan and taking into account early season grain marketing, thinking about seasonality in prices. When we see a rally in corn and soybean prices to the point where you're sitting there saying, okay, this is my rally based on weather, right here in June as it's getting dry. Maybe we see a little bit of a rally, and that provides us opportunities to sell. That is my mantra. That is my mission of getting people to think strategically about risk management. And I think this is a prime example of a year where we've got high cost, not a whole lot of risk protection on the underlying side from like federal commodity support programs. And therefore, grain marketing and being intentional with our grain marketing and our cost in season costs as we look ahead is going to be so vitally crucial. And that matters whether you're in Missouri, in Ohio, in Kansas, North Dakota. That matters. So that's how I would tie all this together.
So Ben, we're kind of running out of time here, but I do want to ask one more question as it relates to this. Whenever farmers are trying to pencil out what their cash flow might look like, and you're looking at those high inputs, but then also maybe some falling commodity, some grain and oilseed prices, how do you work out that balance between how much you're investing versus how much you're maybe trying to not cut corners, but get things to where it's a little bit more cost effective to produce crops while trying not to give up too much yield on the back end? How do you pencil that out as a producer?
Yeah, this is always the big question, or this is always the question. I use a lot of university research, field trials with our plant science folks in terms of yield impacts from doing and not doing in season management of whatever that might be. The other thing that I would simply just say here is economics matter a lot. I know I'm biased. I am very biased, but understanding economics from a lending perspective, a borrowing perspective, how to use your own money wisely to make sure that you're maintaining compound interest. I love that term, and we don't have enough time for me to fully explain my love of that, but economics do matter, folks. And I know it's not the fun thing to do. It's not as fun as sitting on a
Well, it's fun
tractor.
for you.
Well, it is. I love economics, but I realize that is not the attractive thing to spend time doing for most producers because they want to farm. But
Yep.
economics matter a lot, and we're entering into a period where we've got to be disciplined. We've
All
kind
right.
of flipped by the seat of our pants a little bit here the last couple of years, but it does matter. Sorry, I took us way over.
No, you're good. We're running out of time here. But Ben, a quick shameless plug. If farmers really want to look into the article that you wrote on this topic, where can they find that at?
Yeah, so I usually post all my stuff to the Crop and Pest, the MU Crop and Pest newsletter. So if you go to, I believe it's the Missouri Integrated Pest Management news site, you can find the article there, as well as a whole bunch of other stuff related to in-season management that we just talked about.
All right, Ben, looking out for the rest of this shortened trading week, what should farmers and ranchers really be paying attention to?
Well, so everything's delayed a week, or it's a day, sorry. Everything's delayed a day because of the holiday. So our normal reports are going to come out a day later. I will say that the first of the month on Thursday, we'll start to bring in those crush reports. So we'll get our grain crushing and our oilseed crushing reports this week to get an idea of those conversion rates.
All right. Well, thanks, Ben, for your time this morning. It's always a pleasure getting to pick over your brain. Viewers, listeners, if you'd like to learn more about what we do or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. I'm Will Robinson on Brownfield.